Hey everyone, this video is about fair value gaps. So I've got a chart here on the screen, which is on a monitor right over here. So I'm going to look at that and walk you through this. We're looking at a chart here of the SPX, the SPY, and a fair value gap is when, so for example, let's just zoom in right here. When the low of this candle is higher than the high of this candle. In other words, they don't overlap. So the market, in order for the market to be what they say is efficient, you want the market to spend enough time at every given price level to allow the orders at every individual price to get executed. And so when the market runs away, and so you don't have this overlap, in this case, between these three candles, fair value gap is a 3 candle pattern. And it's a pattern where the high of candle number one and the low of candle number three do not overlap. And the market doesn't like that. It's what they call an inefficiency. So most of the time, the market will go back and fill that gap. Now, it doesn't generally fill the entire gap. It usually gets to about the midpoint. So what I've done is I've created a custom indicator, which is what we're looking at here with these white dots. So this white dot right here is literally halfway between the low of candle number three and the high of candle number one. Now the dot here is halfway between the high of candle number three and then candle number one is 2 back. Here's the low. So between this low and that high, halfway in between, there's the dot. So every time there's a fair value gap, this is just an indicator that I wrote in ThinkScript. It's going to put that white dot there. And you'd be absolutely amazed how often the market goes back and gets those dots. So for example, obviously these 2 dots immediately got taken when we had this big day, which covered both of those dots. And then here, this is where the Iran war was taking place. So we had some really wild price action here. So we had this big up day here, and then the second day it gapped up even higher, created this inefficiency. And what happened the very next day? It came back and got that dot. See how it overlapped? So it got that dot. It didn't go all the way down to the high of this candle, but it did get to this midpoint dot. And this happens all the time. Now, does it happen every time? No, it doesn't. And we're going to talk about that. But you'll see, like, for example, this dot here was taken with this candle right there. Now, this dot up here was not taken until all the way. In fact, look at that. This was during this big gap where they announced a ceasefire, and there was a huge gap. And so not only do we have a fair value gap all the way back here, which has yet to be tested, but we also have these 2 new ones because the low of this candle was, of course, much higher than the high of that candle. And also, the low of this candle here is also much higher than the high of this candle. So every time you have a big gap, you're always going to get 2 of these dots at minimum because both of these candles are going to be so far removed from the candles before them. So, but you can see as we went up, this here was a fair value gap, and the next day it was taken. So that one's fine, but this one was not, nor was this one, nor was this one, and nor was this one. This one, actually, did that one get taken? It did get taken. Look at that. It got taken 4 days later. This one here got taken right here. So these 2 were filled, but we've got 3 fair value gaps right here. This is what they call poor structure. When there's poor structure in the market, it means the market ran up too fast. And what does that usually mean? It usually means that the market's going to come back to that at some point. Now, that's not a prediction for tomorrow or next week or next month. I'm not suggesting that the market's going to collapse all the way back to 6,900. At the time I'm recording this video on the 22nd of May, 2026. But the point is that this is poor structure. Now, if you scroll forward, here we had a fair value gap, and the very next day it went and got it. Here we have poor structure again. There's 2 fair value gaps in a row that have yet to be filled. And then right up here, this is where we're sitting right now. This fair value gap got taken the very next day. This fair value gap got taken when this candle came the very next day. And here we go again. As of today, there is another fair value gap between today's candle. Today is a Friday, so this is Thursday, and this is Wednesday. So again, there's a fair value gap between the high of Wednesday and the low of Friday. So in any case, fair value gaps is something they're very good to know because they tend to act as resistance and support. So once the market goes and gets it, like it did right here, it went and got it. And what did it do? It basically bounced right off of it and kept going. Same thing here. It basically bounced off the dot and kept going. The same thing here. So quite often when the market goes and tests one of these dots, it's support and it's resistance. But these indicators that I've created just makes life a lot easier. And I wanted to show you this. It's one of many indicators. I've coded probably 100 or 200 different indicators. Some are useful, many are not. But this is one of the ones that I have on all of my charts. So whenever you see one of my videos, you'll always see these little white dots, and those dots represent fair value gaps, and they are an excellent barometer of what you can expect most of the time, not 100% of the time. Most of the time, if you see fair value gaps, you know the market's going to turn around and fill those gaps. So maybe that gives you an exit, or maybe that gives you an entry into a trade that you were hoping to take anyway. Anyway, that's it for this video. If you have any questions, put it in the comments. Thank you so much for watching, and we'll see you on the next one. Bye-bye.